While landlords are fleeing the market and headlines scream about an imminent crash, a small group of investors is quietly building wealth at a pace we haven't seen in years. They're not waiting for the perfect moment, they're not paralyzed by fear, and they're certainly not listening to the same tired advice that keeps most people stuck on the sidelines. The question everyone's asking right now is whether 2025 is the right time to buy property, or if you should sit tight and wait for conditions to improve. But here's what nobody's telling you. That question itself is the trap. Because while you're waiting for certainty, opportunity is slipping through your fingers at a rate that might shock you. In this video, we're going to expose the real cost of waiting, reveal a housing crisis that guarantees demand for decades, and show you exactly where the smart money is moving right now. But before we dive in, if you want to stay ahead of every major shift in the UK property and housing market, hit that like button and subscribe to Property Reporter. We bring you the latest news, data, and insights that could make or break your investment decisions. Right? Let's get into it. Here's the uncomfortable reality that most property gurus won't share with you. Every single year, people convince themselves that now isn't the right time. Interest rates are too high, prices are too inflated, a crash is coming, the headlines are too negative, there's always a reason to wait. And every year, those same people watch from the sidelines as prices creep higher, rents surge, and opportunities vanish. Let's talk about what waiting actually costs, because the numbers are brutal. Someone who didn't buy in 2012, thinking prices would fall further after the crash, has now missed out on well over 100 grand in capital growth. That's not even counting more than a decade of rental income that could have been covering their mortgage and building equity. Even people who paused during the uncertainty of 2020 and 2021 have missed roughly 50,000 in growth, plus one of the strongest rental markets in living memory. Think about that for a moment. 50,000 quid and years of rent gone because they were waiting for the perfect signal that never came. The myth of perfect timing has probably cost British investors more money than any crash ever could. Because here's the truth. The perfect time only reveals itself in hindsight. When conditions actually look perfect, when everyone's enthusiastic and prices are soaring, that's usually the worst possible moment to buy. And when it genuinely is a good time, when prices have corrected and opportunity is staring you in the face, it feels terrifying. The news is negative, banks are cautious, everyone thinks you're mad, so most people freeze. They wait for someone to tell them it's safe, and by the time it feels safe, they've already missed the window. But there's something even more important happening beneath the surface right now. Something that almost guarantees property will remain one of the strongest investments in Britain for decades to come. And it's a crisis that's been building for so long, most people have become numb to it. The UK is currently short 6.5 million homes compared to similar European countries. Let that sink in for a second. 6.5 million. That's not a temporary blip or a minor shortage. That's a structural crisis decades in the making. To put it in perspective, over 1.3 million households are sitting on waiting lists for social housing right now. Another 123,000 families are crammed into temporary accommodation, including 160,000 children. These aren't statistics. These are people who need homes and can't find them. The government keeps saying we need to build 340,000 new homes every year just to meet current demand. But we're not even close. Recent years have seen us build around 230,000 homes annually, and in some years we've barely cracked 200,000. We've been undershooting targets for so long that the backlog now sits at roughly 4.3 million homes. Even if immigration dropped to zero tomorrow, which obviously isn't happening, we'd still be 6.5 million homes short. The maths is simple and devastating. Demand is crushing supply, and it's going to stay that way for decades unless something dramatic changes. Which brings us to the investor's perspective. When demand massively outstrips supply for years on end, what happens to prices and rents? They go up, they keep going up, and they don't stop going up until either supply catches up or demand collapses. Neither is happening anytime soon. Now here's where things get interesting, and it's going to challenge what you've been hearing from the doom merchants. Everyone's been waiting for the next big crash, the housing market apocalypse that's supposedly right around the corner. Property prices are going to tank, foreclosures everywhere, blood in the streets. But what if I told you the crash already happened and you didn't even notice? Between mid-2022 and now, property prices have already fallen by around 15 to 20% in real terms. Not nominal prices, those have stayed relatively flat. But when you factor in inflation, which has been running hot, the real value of property has quietly dropped by a significant margin. This is what's called a silent correction. It does the same job as a dramatic crash, cooling the market and resetting prices, but it happens so gradually that it doesn't make headlines. Nobody panics. There are no emergency news bulletins, but the effect is the same. Right now, in late 2025, listings are up. Properties are taking longer to sell. Buyers suddenly have leverage again. These are not the signs of a market about to crash. These are the signs of a market that's already corrected and is now stabilizing. If we were truly heading into a bubble-bursting manic crash scenario, we'd be seeing the opposite. Prices would be skyrocketing. Buyers would be paying whatever it takes. Lending would be reckless. That's not what's happening. The market has cooled. It's found a new equilibrium. And while everyone's still waiting for the dramatic collapse, the smart investors are recognizing this for what it is, a window. So if the market's already corrected and the housing shortage isn't going anywhere, where exactly should you be looking? Because not all property is created equal, and not all regions offer the same returns. Let's talk about where the smart money is quietly moving right now. Manchester and Birmingham are absolutely printing money for investors who know what they're doing. Birmingham is projected to see rental values jump by over 22% between 2024 and 2028. Manchester's economic growth is outpacing the national average, and rental yields in both cities are comfortably sitting in the 6 to 7% range for standard buy-to-let properties. But here's where it gets even more interesting. If you're willing to go slightly more hands-on, houses in multiple occupation are delivering average yields of 8.4%. That's nearly double what you'd get from a typical single-let property in many parts of the country. The maths is simple. Renting out rooms individually to multiple tenants brings in significantly more than renting to one household. Yes, there's more management involved. Yes, there are stricter regulations. But for investors who can handle that, the returns speak for themselves. Then there's social housing, which almost nobody talks about, but might be one of the smartest plays available right now. With over 1 million households on waiting lists and local authorities desperate for accommodation, social housing offers lease lengths of 10 to 25 years. Think about that. 25 years of guaranteed income with virtually zero void periods. No chasing tenants, no worrying about whether someone's going to renew. Housing associations typically handle all the management. It's about as close to passive income as property gets. And with the government pushing hard to increase social housing supply, the sector is only going to grow. Northern regions like the North East and Yorkshire are also worth a serious look. Properties in places like Sunderland start from around 56 grand, Bradford from about 59 grand. That's 2 to 3 times more property for your money compared to the south. And these aren't dead zones. They're cities with universities, regeneration projects, and genuine rental demand. The yields are strong, the entry costs are low, and the potential for growth is significant. But let's zoom out for a second and talk about why this housing crisis is actually getting worse, not better. And why that's simultaneously terrible for society, but potentially incredible for investors who position themselves correctly. Only 10% of renters aged 20 to 44 can currently afford to buy a home. Among single renters in that age group, the figure drops to less than 3%. 3%. That means 97% of single renters in their 20s, 30s, and early 40s are locked out of home ownership. They're not choosing to rent. They have no other option. More than half of first-time buyers now need financial help from family just to get on the ladder. The so-called bank of mum and dad has become essential, not optional. And for those without wealthy parents, the dream of ownership is slipping further away every year. House prices have risen at twice the rate of wages over the past 2 decades. The average deposit needed keeps climbing. The age of first-time buyers keeps creeping up. Young people are living with their parents longer, not because they want to, but because they can't afford to leave. This is a generation that will rent for life unless something fundamental changes. And nothing fundamental is changing. Which means one thing for property investors: demand for rental accommodation is going to remain absolutely sky high for decades. Tenant demand in 2024 was nearly double what it was before the pandemic. The average rental property now attracts 19 inquiries, 19 people competing for one property, and rents have jumped by 8.7% year on year as of early 2025, with some regions seeing even steeper increases. This isn't a temporary spike, this is the new normal. The affordability crisis for buyers is the rental sector's growth engine, and that engine isn't slowing down anytime soon. Now, if you're thinking about making a move in the property market, the next 12 to 18 months might offer something we haven't seen in a while: a genuine window of opportunity with a ticking clock. Changes to stamp duty are coming into effect in April 2025, and that's going to influence buyer behaviour significantly. We've seen this before. When temporary nil-rate bans were introduced back in 2020, there was a massive surge in activity right before the deadline. Buyers rushed to complete before the window closed. We could see something similar play out again, which means the market might heat up faster than expected in certain price brackets. The government's also pushing hard on housing targets. Local authorities are now legally required to meet specific building quotas, and there's genuine political pressure to deliver on the promise of 1.5 million new homes over the next parliament. Whether they'll actually hit those targets is another question entirely, but the intent is there. Planning reforms are being fast-tracked, and there's talk of unlocking greenbelt land to ease the supply crunch. What does this mean for you? It means the current conditions, where prices have corrected, buyers have leverage, and sellers are being realistic, might not last. Once confidence returns and transaction volumes pick up, which forecasters expect to happen through 2026, the window starts closing. Mortgage lending is projected to jump by 16% in 2025 compared to 2024, driven by improving affordability and lower interest rates. More buyers mean more competition. More competition means prices start climbing again. Major forecasters are predicting that 2026 and beyond will see stronger growth, with some estimating 4 to 6% annual increases once the market fully stabilises. If you wait for everything to feel comfortable and predictable, you'll be buying into that rising market, paying more for the same property you could have secured now. So let's bring this all together, because the real question isn't whether now is a good time to buy. The real question is, what's riskier, acting or waiting? Most people think risk means putting money into the market when things feel uncertain. But there's another kind of risk that nobody talks about: the risk of doing nothing. The risk of sitting on the sidelines while prices rise, rents surge, and opportunities disappear. That's not safety. That's guaranteed loss. The UK is facing a housing shortage so severe it will take decades to fix, even in the best-case scenario. Demand for rental properties is at historic highs and isn't going anywhere. The market has already corrected in real terms, and we're now in a stabilisation phase that offers genuine buying conditions. Meanwhile, changes to stamp duty, improving mortgage rates, and increasing transaction volumes mean the current window won't stay open forever. If you don't act in 2025, one of two things will happen by this time next year. Either the market picks up, prices rise, and you've missed the easier entry point, or the market stays flat and you're exactly where you are now, except you've lost 12 months of rental income and you're no closer to your goals. Either way, waiting doesn't protect you. It just delays progress. The investors who'll look back on 2025 as a turning point aren't the ones with perfect timing or the biggest budgets. They're the ones who recognised that uncertainty is just another word for opportunity and had the nerve to act while everyone else was frozen in fear. So ask yourself this: a year from now, when you look back on this moment, will you wish you'd moved, or will you be glad you waited?